Hello traders at CMC Markets. Welcome to a new update by RRG Research for the week starting Monday the 6th of March. And I am recording this on Friday the 3rd of March. My name is Julius the Kempenaer and I am presenting to you from Amsterdam in the Netherlands. Let's start with a look at the rotation for the various stock market indices around the world. What we've seen over the last few weeks, and that situation is continuing, is a modest improvement of the US indices. We've seen the Russell here moving into improving. You see the S&P, it's picking up. It's still inside lagging, but it's picking up. And the Nasdaq is actually having the longest tail and pointing towards the leading quadrant. Hong Kong and European indexes are mostly still on the right-hand side. The UK just losing a bit of relative strength, inside leading over the last few weeks, but it's a very short tail, and that usually means that it's a stable trend, so that's not too worrisome yet. We've got the DAX and the CAC and the stocks all pointing to the right-hand side. Shorter tails, again, that means that there are stable relative trends. So they remain strong. The Hang Seng is obviously rapidly losing relative strength right now, but that's after a very long stint of outperformance. So we've got to see how that works, but for now it seems to be taking a break. Japan is picking up, but still far away, inside lagging. And we see Australia and the Dow Jones Industrials actually just crossing over into the lagging quadrant. So big picture here that Europe remains strong and the US is modestly picking up. That's the weekly RRG. If we take that to the daily, then you can see that European stuff is still here. That's still doing pretty good. The Japanese Nikkei is inside leading, but that's a hiccup. Well, on the weekly, it's down in the lagging quadrant, so this is just a temporary hiccup. We see the Russell rotating back into the leading quadrant from weakening. That's confirming the strength that we've seen on the weekly RRG. And here is the S&P. It's inside, crossing over inside lagging, confirming the sort of weakness for the S&P and improvement for Nasdaq, Russell, and to a lesser extent the Dow. The Hang Seng is here, far away to the left. That is because of that long losing stretch that we saw on the weekly. On daily it's picking up a little bit, but the longer term picture for the Hang Seng is still strong. So this is getting back into favor for Hong Kong stocks. Main message for now, Europe remains strong, probably stronger than the US, but the US is slowly picking up again, and we need to take a look at that. We need to monitor that for how that is progressing in the next couple of weeks. If we take all of this to the absolute price trends, and we use this sort of benchmark for the other RRGs was the MSCI World, so that means that these tails were relative. Here we have an RRG that uses a 0% return as the benchmark. That means that we're looking at absolute price trends. And you can see that over the last, this is a 5-6 period tail. Last couple of weeks, stock markets were under pressure. That's why we see all these tails moving to the left. That's losing strength at negative momentum. Obviously, when the price goes down, you've got negative momentum. So these are pretty much all moving in the same direction. But when I change this to a weekly setting, then you can see that the longer term picture for pretty much all these stock market indexes is actually pretty good. They're all moving to the right hand side, except for the Hang Seng, but all of these are pretty much moving to the top right hand corner. They're inside leading or inside weakening and picking up, and the Nikkei is already starting to curl back up while inside lagging. So the longer term picture, the longer term trends for all these stock market indexes is actually pretty strong. Now, a few things that caught my eye this week. And the first thing that I want to share with you, and I think these are going to give you a couple of nice trading opportunities where you can take a look to build up some positions. And here is the breakdown of the US stock market, and the center of the chart, the benchmark here, is the S&P 1500. This is the S&P 500, of course. The mid cap is the S&P 400, and the small cap is the S&P 600 index. There are all ETFs available for those indexes, so that's very tradable. And what we see here, again, the benchmark is the S&P 1500, so that's the composite, that's the broader market. And what we see here is a very clear preference for mid and small cap stocks, mid and small cap indexes. They have really long tails, which means that these trends are powerful, they are long, whereas the tail for the S&P is much shorter, and it's pointing downward into the lagging quadrant. So mid and small caps powering into the leading quadrant at a strong RRG heading, with the S&P powering into the lagging quadrant at a negative RRG heading. So positioning that either with ETFs, with CFDs, no matter how you want to create exposure, but you could trade this market offsetting positions in small and mid cap ETFs or indexes or CFDs on those indexes, whatever translation into exposure you prefer, and offset that against the S&P 500, again, either an ETF or a CFD. But this looks to be a pretty good trading opportunity to benefit from the widening spread between mid and small caps on the positive side and the S&P 500 on the weaker side. If we look at the individual charts for mid caps, here's the mid cap index, and you can see that we have a very nice bottom formation around 2200 coming out of it. We've already struggled with some resistance around, let's say, 2600, and we're now pushing against 2700. So this is a bit of a range after the peak. We tried to break 2700, didn't work at that time. So this is a weekly chart, so that's 3-4 weeks ago. And we're now resting at support offered by that previous high, which was resistance at that time. If we remain above this level, and if we can take out 2700 to the upside, that is very likely going to give a new boost to mid-cap stocks. And look at the RRG lines. RS ratio is very nicely gradually rising, and the RS momentum line is coming off a dip around 100, but it's starting to pick up again, and that's powering that mid-cap trail into the leading quadrant. If you look at the small caps, it's quite similar. Again, coming off sort of trading range, took out the first resistance, in this case 1240, and we're now pushing against 1300. If we hold up above 1240, and if we can take out 1300 in the next couple of weeks, then it's up and away for small caps, and that's also translated here in a positive move for the RRG lines. So mid and small caps very clearly outperforming and showing relative uptrends versus the S&P 500 and as a benchmark the S&P 1500. If we move to US sectors, then there's an interesting move going on. And I think I've already discussed this with you, that there is a situation where we are seeing defensive sectors, so that's healthcare, staples, and utilities, all moving into the lagging quadrant at a negative heading. And that all started, you can see how long these tails are. This is 1, 2, 3, 4, 5 weeks of price action, and they're already pointing down or in a negative heading for 4, 5, 6 weeks. And the S&P didn't do particularly well over that same period. And that's strange, because these sectors, these defensive sectors, should, if the market was really weak, these sectors are expected to do really well, because these are the safe havens. These are the defensive sectors. Investors usually move to these sectors when they're worried about the market as a whole. That did not happen, even despite the fact that the S&P went into some sort of a correction after the initial rally. Market continued to sell these defensive sectors, and I think that if you translate that, that is a positive thing, because even despite the fact that the market was coming down a little bit, investors continued to sell these defensive stocks in favor of, for example, information technology, communication services, consumer discretionary. These sectors are much more offensive and sensitive, economically sensitive sectors, and they are continuing to do really well. Communication services is taking a little breather right now, but it's continuing higher on the RS ratio scale, which is good, and it looks as if it's only a matter of time before it crosses over into the leading quadrant. These bubbles indicate the market capitalization of those sectors, and you can see that information technology and consumer discretionary are really big sectors, heavy market cap sectors. The other one is healthcare, that's going the other way. But these two are so consumer discretionary, it's the lowest line, I'm not sure if you can read it on the screen, is the lowest line on that dialogue, 10.92, so it's almost 11% market cap, and information technology here is 27% market cap. So we're looking at almost 40% of market cap that is outperforming the benchmark, which is a good thing. Then we have industrials, materials, and financials inside the weakening quadrant, but there is plenty of room for them to maneuver back upwards. And then finally, there is the energy sector, and that's where I want to focus a little bit more for this occasion. It's inside weakening, it's losing relative strength. However, it's still possible that we're going to turn back up. But what I want to do, because I think there's something interesting going on, that's a tradable opportunity going on inside the US energy sector. And we can see that if we break up or if we load up the components of the energy sector. So what we're looking at here are all the stocks that are inside the US energy sector. And again, the bubbles represent the market cap of those stocks. And there is two stocks that are standing out. And it's inside leading, it's Exxon Mobil at 27% market cap, and here is Chevron at 19% market cap. And lo and behold, and that's what I'm looking at when I look at these RRGs, and I'm looking for trading opportunities. I'm looking for tails that are moving in opposite directions. So one that could also be a good trade is APA versus VLO, for example. You want to look for tails that are moving in opposite directions. For this occasion, I want to focus on the two heavyweights, the two big cap stocks inside energy. So that's Exxon Mobil and Chevron. And over the last year, and let's go to the individual price charts for these. So for a long period already, it was actually Chevron leading the energy sector. That was the most important stock inside the energy sector, and that is now turning around. We had a new period of leadership for Chevron against the energy sector index. Didn't work, and you can see how it's now rolling over. More importantly, if you look at the price chart, you can see that it just completed a double top pattern, broken down. We're now just hovering above that rising support line. The upside, this old support level is now expected to act as resistance, so the upside is quite limited. And if we break this support line, then there is quite a bit of downside that's becoming available. And in the relative strength chart, you can see that both RRG lines are moving lower, and we're already breaking below support in that raw relative strength line. If we go to Exxon Mobil, you see a completely different picture. You can see how that relative strength line is actually moving higher. It's taking over that leadership role from Chevron. And you can see how that's translating in the RRG lines, both way above 100, pushing that tail deeper into the leading quadrant. But more importantly, Exxon Mobil is managing to hold up above that breakout level and is actually setting a new higher high, a new all-time high in that sector. So that's really a good thing. So compare this chart here for XOM with the one here for CVX. I'm pretty sure you agree with me which one is the better of the two. Again, this offers great trading opportunities, either through buying the stock directly or a CFD on those stocks, or whatever way you want to translate any trade idea into a actual position. And that's it for this week. Thank you for watching. I hope you enjoyed the show. I'm looking forward to seeing you again at a new update by RRG Research next week, same time, same place.